and Peter Boockvar. Welcome back to F.A.C.E.
Morning.
How are
Thanks
you?
for having me.
Good to hear you, Peter. So I'm going to share my chart so we could go over things. So why don't we start with what happened today with the GDP reading?
It's old news. I mean, we're a day away from ending Q2, so Q1 is water under the bridge.
Okay. All right. So you did a great spot last week on CNBC, Peter. I caught it. And you were talking about they gave you a chance to be the Fed chairman and talk about what you would do. And, it wasn't any surprise to you what they did, right? So looking forward, do you think the little break in commodity markets are enough for them to maybe taper their hawkishness, temper it?
Not yet. I think they're intent on getting the Fed funds rate to 3. Now, whether they get there, we'll have to see. But I think they're of the mind that they're more focused on getting the Fed funds rate to a certain level, called 3, from there, which they can pivot either way. So if they get to 3 and all of a sudden inflation starts to really roll over, well, then they feel they have rates to cut if they need. And then, of course, if things stay hot, well, then they have flexibility on the upside by having the Fed funds rate already at 3. So while they may say they're data dependent, I think right now they're almost Fed fund target dependent, and that they just want to quickly get to a certain rate. Now, they're still only halfway there. They'll compensate by likely going 75 in July, which will take them to 2.5, which ironically is where the Fed funds rate was taken in the fourth quarter of 2018, 2.25, 2.5.
Okay.
So the question then is, after you get to 2.25, 2.5 at the next meeting, what do they do in September? They'll just probably raise another 50, but there's still a lot of things to digest between now and September. But if I were to say, they would be 75 in July, it'd be 50 in September, and then they would have a chance in their eyes to sort of look around, survey the landscape, see how the economy and the markets have responded to their rate increases. At the same time, it's only going to be September when QT starts to max out. So that's very early innings in that form of tightening. So there's still a long way to go here.
So is this pullback in
and what the response is?
Yeah, this little pullback we had, and it was kind of a buy the rumor, sell the fact on the last Fed rate hike. Is this just another pullback similar to this before we see a wave above 3.5% on the 10-year? Or is it already baked into the 10-year, what they're going to do next in July?
I think we can't. Well, I think the short end of the curve, I think the 2-year, 3.10 here is priced in all the rate hikes. So that, to me, I'm pretty confident that those yields have peaked. The longer end yields, 10-year, as you point out, is more difficult to predict because it's not just about U.S. growth and inflation that's driving the 10-year. It's what's going to happen with yield curve control in Japan, what's going to happen to European bonds as they finally stop QE tomorrow and eventually start raising interest rates in July, and where they can take them. So we've had an epic sovereign bond bubble over the past 10 years, and that was exaggerated by negative interest rate policy that is now reversing. And if we wake up tomorrow and go back to the Bank of Japan, if they decide to widen their yield curve control band to call it 50 basis points or even 75, I don't think they'll go to 75 in one move. It'll probably be in baby steps. Then we can wake up and we can have another round of global bond selling. If the German 10-year goes to 2.5% because the ECB is pussyfooting with tightening policy, then we can get to 4% in the 10-year. But we're not getting to 4% in the 10-year again because U.S. growth all of a sudden accelerates. It's because inflation's sticky and we have this continued unwind of this global bond bubble.
Who's on the other side of the runoff and the Fed not being a buyer, who's stepping in for the Fed? And, you know, I look at the TLT, Peter, and I don't think I'd be short bonds down here. Could we, you know, have some type of bear market rally in bonds that would surprise people? And what would be a catalyst for a bond market rally? Because I don't know if it's going to be risk off.
You need the price of oil. I think you need to, in order to get a real bounce.
Okay.
You need oil prices below $100.
Okay.
I think. You know, we had a bunch of auctions, Treasury auctions this week, 2s, 5s, 7s, and they were all pretty crappy. So here you have the highest yields that we've seen in many years, and the auctions were crappy, which tells me that, you know, bonds don't trade well. And one very, very important bond that I like to look at in this whole sort of global debate on yields is the Japanese 40-year yield. And I say 40-year because it is the furthest out on their yield curve and therefore the least influenced by their manipulation of negative rates on the short end and yield curve control at the 10-year. And overnight it fell 3.5 basis points, but prior to that, at about 141, it rose to a 6.5-year high. And that tells me that the pressure is just intensifying on the BOJ and also in global bonds generally. Okay,
well, you know what? Maybe we're going to have some type of important inflection point in the yen with what you're seeing out there. You know, parabolic move. Is this a crisis with what's happening with the yen and what the Swiss did by, you know, SNB turning hawkish?
Well, it's a budding crisis, and whether it actually rolls into one, we'll have to see. I mean, I think the yen needs to get to probably 150 before the screws are tightened enough that the BOJ would widen their band and therefore lead to a rally in the yen.
Okay. All right. I'm actually looking for something short-term top. How about the dollar, Peter? I mean, dollar was getting a lot of press. It's not getting as much because of the yen performance compared to the dollar. Does this look, technically, I'm starting to build a case for something toppy up here. Can you think of what's going on in the central bank world and the yield world? How there could be a bear case for the dollar, even if it makes one more high above 106 or so?
To me, the potential inflection point with the dollar was the as you mentioned, the Swiss National Bank surprising and raising 50 basis points, because that was, at least from their perspective, a sign that they're now obviously pivoting in a big way, and that other central banks are doing the same. And when you think about this rally in the dollar, well, up until a few months ago, it was really only against the yen, the euro, and the pound. Commodity currencies were trading well. And then, of course, the dollar started to rally with everything else as commodity prices fell. But it's really just been about interest rate differentials and differentials in between different central banks. And if other central banks are going to catch up, well, then the dollar sort of loses its edge. And I would not be surprised, again, if that SNB move was the catalyst for a peak of the dollar. Now, we'll have to see, but I think that's what I'm watching out for.
Okay, and should there be a dollar peak, do you have a preferred fiat alternative to the dollar, or is it still, and I understand the case,
I still like the commodity currency. I still like the commodity currencies because I think commodities, notwithstanding this pullback, are still in a bull market. So the CAD, the Aussie in particular.
Okay. All right, and here's a look, Peter, at the Aussie, and it's a big consolidation triangle, and I'll be doing
and I'm still intrigued by the pound too. I mean, the Bank of England's also beginning to shrink their balance sheet. I think they're going to pick up the pace of their rate increases. So I wouldn't be surprised if down the 120, 122 level, the pound bottomed as well.
Okay. All right. Definitely. I mean, just from a technical point of view, this looks like, look, it really hasn't given back much from the COVID low compared to things like the pound. You're right, the commodity currencies have had the relative strength, euro taking out the COVID lows.
Right.
So a lot of people have complained, Peter, about gold being a lousy inflation hedge. I've thought that it was going to take a bear market in the dollar that's more of a monetary hedge. But you have to respect, even though it hasn't gone up, how well it's held. I mean, they keep trying to break it, and it's holding pretty well. It was easier to understand being long gold while the Fed was in easing mode for all those years. What is the bull case for gold as there's more opportunity cost as rates go higher?
Well, your initial point of gold trading well, I mean, when you think about everything that's thrown at gold, yes, we have inflation, but the sharp rise in interest rates in response,
right,
and the sharp rally in the dollar, and gold still trading between $1,800 and $1,900, which is pretty good performance. And yeah, gold has not been what people would perceive as a good inflation hedge, but I think that has more to do with the interest rate response to that rise in inflation. The catalyst for gold on the next move will be the Fed's knees that buckle in response to a recession, and that happens well before inflation gets below 2% or even at 2%, and that inflation's only down to 3 to 4, and all of a sudden the Fed starts worrying about a recession, and therefore and therefore they want to pause, at least, because they're not just going to go from raising to cutting. They're going to go from raising to pausing to then cutting.
Right.
But the second that they pause, before they have predicted, right now the dot plot has them at near 4% next year. The Fed funds futures is saying something more like 3.5%. And if all of a sudden they stop at 3%, well, there goes your dollar rally, and you're likely to see a nice rally in gold and silver when that happens. But again, prior to that, gold's trading pretty well. Silver has been disappointing, no doubt, but gold is hung in.
Okay. Yeah, we need a top in this gold silver ratio for silver to begin to lead, and it looks like it's trying here. I like them both. In fact, Peter, I don't know if you really follow the miners, but
I do.
Just a couple.
We own them.
You do? Okay, you own them. All right. Well, I look at some of the gold miners. Here's GDX, and here's Newmont. Almost at new lows. And you talk about the weakness in silver. When I look at some silver shares, they're putting in higher lows. That's Endeavor, and that's Fortuna. So, I'm seeing the opposite in the miners, that there's more relative strength in the silver shares. And what I really wanted to get to, I'm going to bet $1, Peter, that no one's asking you, why would you like gold more than Bitcoin? You get that question anymore?
No, I don't get that anymore. I don't hear Bitcoin is digital gold anymore. I don't hear that anymore. That's not to say that it maybe one day will be a complement to gold.
Yeah.
But when people were preaching to me that something that is 10 to 12 to 13 years old, depending on when they had argued this to me, that somehow that was going to replace something that's been around for 5,000 years.
Yeah. So do you think there's a possibility? I've heard some people and read some things that there could be a move out of crypto into gold after this decline, that people lose faith in it, and it's not doing the things it was supposed to do for them during, didn't do much for them when the dollar was strong. Let's see what happens, what it does for them if the dollar weakens. But
I mean, I just don't know how to quantify the amount of dollars that were in Bitcoin, which that holder would have previously been in gold. To me, instead of digital gold, Bitcoin ended up being just digital QQQ. That's what it turned out to be, or digital ARC.
There you go.
So
a little more like ARC.
I don't know if necessarily money comes out of Bitcoin and into gold. And keep in mind, you can't have money come out of Bitcoin because for every seller, there's a buyer. So,
True.
And same with gold. For every buyer of gold is somebody selling that gold to that person. So money doesn't come out of an asset class. Money gets just shuffled around.
I'd like to, I'm going to ask that question in reverse to my next Bitcoin guest. As why would you prefer Bitcoin over gold?
Yeah. Now, I Bitcoin and owners and gold, they still have a similar mind. Obviously, putting aside the people that were just buying Bitcoin just because it was a hot thing for a while, and they just wanted to ride the train. But the basis and theory for Bitcoin is still similar to owning gold. So there is a soulmate type relationship for the creation of Bitcoin and those that are critical of central banks and the policies they've conducted and the bullishness those people have on gold. So I sympathize with Bitcoin and maybe it does weather this and stand the test of time. But time is not 13 years. Time is going to have to be something more than that, because the last 12, 13 years, the only thing Bitcoin has really known is QE, zero rates, and that's it. Well,
Untested.
that's a nice childhood, you can call it. Now it's getting tested, and life is not as fun, and we'll see how this plays out.
Okay, so let's go from childhood to adolescence and talk about China and what you're seeing there. I know their equities really took it on the chin last year, but there's been some outperformance by Chinese stocks. Are they a no touch for you, or is there Shanghai seems to have the best structure of any bourse out there? You have a view?
Yeah, we have some exposure, sort of kind of indirectly. We own some of the Macau casino stocks. One's Las Vegas Sands, so it's not really a Chinese company, but they do a lot of business there, of course. So AIA Group, which is the largest insurance company, or one of them in Asia, they're based in Hong Kong, and they do a lot of business in China. But to me, investing in China is I'm less worried about the regulatory issue, like on the audit side, because you can just buy the shares in H shares in Hong Kong, as they are fungible. But I'm more concerned with just this maniacal approach to COVID, and it just doesn't make any sense to me whatsoever at this point, with the rest of the world proving how you can successfully manage it. I mean, I know China's worried about their healthcare system, but look at India. I mean, India, which we're very bullish on, doesn't have even the healthcare system that China does, and they have powered through this. Now, granted, they have a younger population, which can handle it, but I want China to pivot, and they haven't done it yet.
Yeah, that's leading people to say there are other reasons for it. And in fact, I don't know, is it fake news that they could, Chinese, when they go to their ATMs, they have a limit to what they could take out on a daily basis? Or was that fake news?
I don't know. I mean, with this authoritarian government, anything's possible, of course.
Yeah. Okay. What's on your radar going into here we are, it's the summer, just started. What are the major events?
Yeah, the next big thing is corporate earnings. When you look at the three drivers of stocks, it's the multiple, it's revenue growth, and the profit margin on that to derive your earnings per share. Well, we've already seen a re-rate on the multiple side. We're about to see a deceleration on the revenue side because we're either in or about to enter a recession. And we've already seen a moderation in profit margins. So this earnings season, which starts in a couple of weeks, even though we got a taste of it with FedEx last week and General Mills and today, that is going to be the next major driver, because earnings estimates from the sell side have not budged, basically. And that, to me, the 228, 230 earnings estimate for this year, to me, is la la land. And I think earnings will go a long way in readjusting. Earnings season will go a long way in readjusting those expectations.
Okay. Any levels you're looking at in S&Ps? I'm sensing you feel it's not priced in. So a lot of people were talking about going back to the pre-COVID highs, about 3,200. Is that viable?
Yeah, it's like around 3,350, 3,400. Yeah, I think that that's definitely possible, and there's a wide range of outcomes here. I mean, even if you just look at the average bear market, it's down 35%. Now that's average. Some are obviously down less, some are down more, but that would take you to 3,100. What if we have a bear market that's similar to the two prior to COVID? Well, that takes you to 2,400. So there are a range of outcomes. So you really have to not be dogmatic, and you just have to be aware of that. It's a bear market. You have multiples falling at the same time earnings are about to fall, and that's what creates a bear market. At the same time, you have inflation at 40-year highs, the most aggressive monetary tightening in 40 years, and that it's going to be a very choppy, challenging investing environment for a while.
Okay. You concerned at all about what's happening between Russia and Ukraine, and anything geo that you have your eye on?
Yeah, of course, it's a concern, just because when you are in war, you just don't know where it goes, what mistakes are potentially made. Now, I don't think that Putin is going to focus on a NATO country. I think he wants what he wants in Ukraine, as tragic as that is. But you never know what sort of mistake is made, or an accident that occurs that can create something more. You always have to worry about the U.S.-China relationship, and it just seems to be so toxic. And the world needs strong China economically. The world needs their supply chains. The world needs their consumer and their growing middle class. So we want China's economy to succeed. It's just this very, again, authoritarian,
acrimonious.
Yeah,
and that's the only thing that both
dangerous.
Democrats and Republicans agree on, is their disdain for China.
Yeah,
they both
exactly.
It's weird.
I feel like we have to stop being afraid of competing with them, and that seems to be, our fear of that seems to be driving policy. Which I don't think necessarily leads to good decision making. Okay,
Peter.
We've done pretty well competing against the world over many centuries.
Yeah. What are they afraid of? We're always, that's us. We have that competitive spirit, and Peter provides some things that might give you a little competitive edge on your view of the markets here at the book report. And you have both free, and then you could also subscribe. Peter, it's always great talking to you.
Thanks, Dale. I always appreciate having me on.
Yeah, and I cheer for you when you're on CNBC.
Thank you. I appreciate that.
Okay, so everyone, Peter Boockvar, thank you very much, Peter, and I'll get a hold of him. We'll talk in the fall, see how things are shaping up in this Meshuggah world.
Great. Be well.
All right.
Bye.
Peter Boockvar, everybody, and remember, don't just count your pips, count your blessings. Hoping that this session today helped you out. The guys will be available in 20 minutes on the Morning Edge. Have your questions ready. And like Peter says, a lot of real smart guys I know are starting to smell a potential top in the dollar. So get your war chests together. So that's a wrap, everyone. Have a great day. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.